Assalamualaikum, everyone. We are looking at the Murabaha pricing, whether or not we should be giving focus to the sale price or the profit rate. And I have said earlier that this can be an issue of two sides of the same coin. But then because we are dealing with financing Murabaha rather than spot Murabaha, that is why a lot of attention has been given to the profit rate instead of the sale price or selling price. And but then we need also to recognize the fact that when we look at Murabaha financing, we are looking at the contractual perspective or the akad perspective. The akad of Murabaha, whether it is a spot Murabaha or financing Murabaha, we are still referring to the basic pillar of the sale contract in the akad of sale, where the three pillars of akad, meaning that the Tarafa'il Aqdi, or the agent of contract, the buyer and the seller in the case of sale, and the Mahalul Aqdi, the subject matter, and that will include the price, the thaman, as well as the asset. And then we also look at the ijab and kabul. So that is why in Murabaha financing, we are still recognizing the role of the sale price, because that's how the akad of sale or the akad of sale in Murabaha is to be treated. So the selling price can be based on a spot price, or it can be based on a deferred price. Either way, on the akad side, the sale price have to be defined as clearly as possible. And of course, when we look at a sale price of Murabaha financing, then the content of the sale price is more than, it is more than the ingredient of the spot sale price, because the spot sale price will be equal to the cost price plus the profit margin, and the profit margin is simply the profit set by the selling party based on the marketplace. So there is a acceptable profit margin acceptable in the market that the trader or merchant will use. And if the profit margin is made very high, then nobody will come to the trader to buy. And if the profit margin is made lower, then the trader will of course make less profit. Maybe in the sense that there is more people coming to him or to her, but then the profit derived from the sale will be much lower because other people are still selling at the prevailing profit margin. However, when we look at the sale price in financing Murabaha, the profit margin is much more detailed because we have the facility amount multiplied by the profit rate and multiplied by the tenure, and the profit rate is something that is not existing in the spot Murabaha. So the profit rate is finance charge based on the time value of money, based on the postponement of the payment, right? So that profit rate, need to be further understood so that we can have a fair idea what exactly is the profit margin that the Islamic bank have imposed onto the sale price. So So we can see that when we look at the financing side of the coin, which is financial Murabaha, then the pricing will refer to the profit rate of the facility, and the profit rate of the facility will ultimately determine the profit margin for the financing arrangement. And that is why we want to see in more detail the component of the profit rate. And as we have seen earlier, that the profit rate is the sum of the base rate and the spread, and the base rate will be the cost of fund that can be coming from the current account rate or the saving account rate or the fixed deposit rate. But in conventional practice, we see that the bank is using the overnight policy rate as the base rate, and they will essentially add on another increment in the form of a credit spread, right? So the credit spread or the additional profit rate is coming from the credit standing of the customer. So the spread is determined by the credit standing of the customer, and this is where a lot of discussion and debate has been undertaken to further understand the basis of determining the profit rate in the Islamic bank. The base rate is based on interest rate, which is the overnight policy rate, which is a riba rate, and the spread is determined by the credit standing of the customer. And of course, in the Islamic tradition, we do not have this kind of financing arrangement because al-bay' in the early Islam is normally transacted based on spot payment rather than deferred payment. So I would presume that spot payment is the general theory, right? The general practice, whereas credit payment is a special event or special case for al-bay' because the dominant activity of trading based on spot payment. So there is not much theory that we can find to explain how is the profit rate determined, meaning that how is the profit margin is determined when the payment is made based on credit mode. All right, so that special case, I presume that is coming from the early tradition, have somehow required us to think more about how profit rate of Murabaha financing be determined, and what would be the Sharia explanation for the spread as well as for the base rate, right? So we see that the profit rate is the sum of the base rate and the spread, and for Malaysia the base rate is the OPR rate of 3%, and the spread is, let's say, 2%, given the profit rate of 5% with a base rate of 3%. So the spread is 2%. So how are we going to explain this 2% profit rate arising from the spread or arising from the credit risk premium, right? And we see earlier that the base rate is based on the overnight policy rate, and that overnight policy rate is influenced by monetary policy and not by the commercial bank. So the commercial bank have no influence on the setting of the OPR, so that would be conducted by the central banks of Malaysia. And what we can see that the commercial bank have control on is the spread, right? So the spread is based on the credit rating of the borrowing party, and the spread is influenced by the risk appetite of the commercial bank. And what is risk appetite? So risk appetite is the amount of risk that banks are willing to accept to achieve its profitability objective. So bank would make risky loans, and when the bank make risky loans, they would charge higher interest rate or higher profit rate. So when the bank make less risky loan, then the bank will charge lower interest rate. So this kind of loan strategy or business model, will impact how much profit that the bank can acquire, and that risk appetite, of course, will be approved by the board of directors. And if meaning that we do not want to see a bank to be too aggressive in making loans, meaning that being too aggressive, it may imply that the bank is making a lot of risky loan in order to garner the higher interest rate from this risky loan, but then the impact will be adversely affecting the bank when there is a default on this risky loan. But when the bank want to be a bit conservative and be on the safety side, they'll make less risky loan, but that will mean lower interest rate and lower interest revenues, and maybe the bank will not be able to achieve its profitability objective. So this is essentially a very interesting area for us to further examine. Then I will see you all in the next video talking on this issue. Thank you very much. Assalamualaikum warahmatullahi.